Okay, thank you everybody Thank you everybody for coming. I really appreciate it. And my name is Jordan Roy-Byrne, obviously, and I focus on market timing, which is technical analysis, and stock selection. And my presentation today, if you want the 10-second version, then pay attention now. It's basically my title. We're going to have one more leg down in precious metals, and then potentially the greatest setup ever. So that's the really short version. Now I'm going to go into the details. So I know you guys hear many presentations, you get a lot of info, so I like to summarize things so you can get a couple key takeaways. And as I said, it looks like we're going to have one more leg down. Number two, I'm going to go into that. The bottom on average, as far as the shift in Fed policy, the average and median of the data says the bottom is usually 3 to 4 months after the last hike, but obviously it could be shorter than that, it could be longer. And then we're going to go into one of the greatest setups ever. So we're not in a bull market for precious metals. I know that there's some people out there who say we're in a bull market. I think Rob McEwen was on Kitco and he said we're in an invisible bull market, which obviously Rob McEwen is way smarter than I am, way richer, but I'm sorry, that doesn't make any sense. We're not in a bull market any way you want to slice it. So let's get that straight. Precious metals are still in a downtrend, and if we can start there and get on that point, then we can move forward. So this is really the key, and I'm glad Greg was talking about a catalyst. He didn't mention what the catalyst was. Thank you, Greg, for teeing it up for me. The catalyst is a shift in Fed policy. And I last year, now stepping away for a second, fundamentally speaking, 90% of what moves gold is basically real interest rates, inflation-adjusted interest rates, and the trend there. Is it rising? Is it falling? The reason precious metals have been in a downtrend, real interest rates from 2011 through 2015, they were rising. Okay, they were really negative and they went less negative, but they were rising. So precious metals were less appealing fundamentally. Then in 2016, we had a shift. Real interest rates were falling, and 2017 and recently they might be going down a little bit, but anyway, there's no manipulation. There's nothing has been happening that's out of the ordinary as far as precious metals. But so the fundamental shift, you either need to see an acceleration in inflation, which does happen. I mean, it has happened sometimes, and I think we're going to see that, but not immediately, but into the future. It's either that, or for the most part, it's really been the Fed moving from hikes to cuts. And so over the last 65 years, there's been 13 times where they've moved from hikes to cuts. And 11 of those 13 have marked, really good buying opportunities in gold stocks. And I use gold stocks because they have the longer history. Gold was fixed in 1971 and onwards. Gold stocks obviously go back much farther than that. So 11 out of 13 of those cycles, the average gain in gold stocks was 172%. There's a pretty big variance there because sometimes the gains have been a lot more and sometimes they haven't been as much. And as I said, the start of the move tends to be an average or a median of 3 to 4 months after the last hike. So the real key is when does the market sense that shift in Fed policy where they're 100% sure the Fed is done hiking and they're looking to cuts. And so we're not quite at that point yet. This is really interesting to me, but this is the rate cut probability in 2019. And just a couple weeks ago, this hit 46%. Just a couple weeks ago, a 46% chance of a rate cut this year, not 2020, but this year. So, I mean, it sounds kind of ludicrous to already be talking about cuts, but we had this 20% move down in the stock market. Economic data is getting a little bit worse, but not recessionary yet. And the rate cut probability, because of those things, got all the way up to 46%. So what we need to get that rate cut probability much higher, and around 70 or 80%, is the stock market needs to weaken more, economic data needs to get worse. So watch, you know, I said this in my last talk, but the stock market is going to be a leading indicator for precious metals, especially this year. I mean, there's kind of an inverse relationship going on right now. So that's important to keep an eye on, because if we see more weakness in the stock market, we see another leg down, that is obviously going to shift the market away from thinking about another hike and to the start of cuts. That's obviously bullish for precious metals. That's the catalyst that we're looking for. But even if December, you know, as I said, the 3 to 4 month thing, it varies. If December is the last hike, I mean, it might be 10 months or 9 months. We don't know, but we know that the catalyst is the shift in policy when the market knows that they're going to cut. That's when we see bull markets start in precious metals. And I'm going to talk about a couple things that happen before we get before bull markets start. And you know, I was here a couple months ago and I was talking about, you know, gold against foreign currencies. And another way to look at that is gold multiplied by the dollar. So that chart is at the bottom, gold is at the top. And so what happens before big moves in gold or bull markets is it tends to strengthen against foreign currencies first. So it tends to bottom and start rising even before the dollar peaks. And there was no positive divergence here a couple months ago, but now it's a couple months later, and you can see right here just recently, gold against foreign, it made something like a 20-month high, and whereas gold and US dollars nowhere even close to getting up to 1360, much less even breaking above it. So we do have the start of something here, a small positive divergence. And I love to see this chart make another leg higher even before gold tests or breaks 1360. If we get that another leg higher in this, again, this is a leading indicator, that would be a very good sign for gold. And we're looking for the same thing in, so here we have gold against the stock market, gold obviously. We see the same thing where gold tends to strengthen against the stock market before bull markets begin. And it works the other way around too. I mean, go back to the mid-90s. Gold had this slight move higher here, 95, 96, higher high. But against the stock market, it was weakening badly. So that was a huge negative divergence. And we saw the same thing 2015, 2016. I mean, we just had this big pop in the beginning of 2016. And it was just a pop for a couple weeks or a month. And there wasn't another leg higher. So we have seen gold strengthen against the stock market, but like I said in the last chart, I really want to see this make another leg higher. Even if gold isn't testing or breaking this wall, if we just see these leading indicators make another leg higher, that's going to tell us we're much closer to the end of this downtrend in a real bull market beginning. Okay, so I'm going to do some technical analysis here on the gold stocks. This is GDX, and you know, I was here a couple months ago and I was too bearish. We did have this rebound, and just one thing about technical analysis, it's not that technical analysis doesn't work. You just have to learn how to interpret it correctly and properly. I mean, I was too bearish here a couple months ago, saying we're going to have another leg down. You know, one thing I ignored. This is a breadth my own breadth indicator, but looking at the percentage of stocks that close above the 200-day in the Huey, which is, it's not GDX, but it's very similar. And this was down, I think around here it was below 10%. So I got too bearish, I kind of ignored that. But nevertheless, I hope everyone enjoyed that little tax loss rally we had. It's over, it's done. The next leg down has already started. So we're probably going to lose, we're going to lose some money in the next couple months. I'm sorry to say, but that's what it looks like. And I see similarity where we are right now. It looks very similar. That's why I have this line here. Looks very similar to early 2015, middle of 2015. And the reason I say that is because if you go back to 13, 14, we had this consolidation here, and then we had a breakdown to leg lower. We had this consolidation here. What happened? We broke down, leg lower, a little bit of a weak recovery. What's this here? Weak recovery is a little bit longer. But during this recovery, look at the advanced decline line. it was making lower lows. That's a bad negative divergence. And this is what I was talking about a couple months ago. I mean, the negative divergence in the advanced decline line, which is a great leading indicator, is still in play. So, what happened from this point? We had a leg down, stabilized, false new low in January, then a huge move higher. And this happened after bumping up against the 400-day moving average a couple times. So we've been testing. We got up to the 400-day, failed in the last week or two. And I don't know how anybody can say we're in any kind of bull market. Just look at the 400-day moving average. We're not in a bull market. I mean, I guess we were for a little while in 16 because we went above it, but it provided resistance throughout 2011 to 2015. Every time we had a good rally, and so we've seen the same thing just recently. We rallied up to it, but failed, and given where these breadth indicators are, again here, I mean, when you're in a bull market, the percentage of stocks above the 200-day, I mean, they're getting up to 90 and 100%. Look at what happened here. I mean, we shot up, and very quickly we got up to 80, 90, 100%. And, just other than that, you can see here we've been below 60% basically the entire time. I mean, that's a downtrend. We're not in a bull market. So bad news is we're probably starting a leg lower. Well, it's already started. But the good news is, just from this comparison, it's probably going to be the last leg lower. One more leg down, and then we're going to get ready to start the bull. And this is GDXJ, and again, 400-day moving average. This is zoomed in a little bit. I didn't have this on the last chart, but one difference from 2015 is gold stocks have been able to break above the 200-day moving average in this chart. So relative to the stock market, they've been able to break above the 200-day. It looks similar for GDX. That never happened until we had that big move. So that's one bonus and one reason why I think we're not looking at like a huge leg down. But nevertheless, this will be something to watch over the next couple months. Can the gold stocks, and even gold, are they going to hold above the moving average? How are they going to perform relative to the stock market? These are the things that we have to watch when gold is not in a leg higher. And this is, again, my own indicator. I have a basket of 55 juniors. Like half of them are GDXJ, larger type juniors, and then half are small. Percentage above the 200-day. I mean, we see the same thing here. Look, since the beginning of 2018, it's not even close to 60%. I mean, look at this. This is a downtrend. We're not in a bull market yet. Okay, so let's go to the valuation charts. I mean, I did this kind of backwards. I probably should have put the valuation charts first, but I wanted to get the more important short-term timing stuff out of the way. But so this is the gold stocks going back to 1928, 10 and 20-year rolling returns. You'd see the indicators right here, obviously. And there's basically 3 times when gold stocks have been extremely oversold on a long-term basis. So we're looking at the late 50s, 2000, and then basically where we are now or the last couple years. So, I mean, gold stocks in the late 50s, they had gone nowhere for decades. And this is the TSX S&P Gold Index. But the Barron's Gold Mining Index, that really shot up in 1960, 1961. Whereas this index, it took a little while for it to get going. But nevertheless, I mean, the point is, you can look at 1957 as an important low for gold stocks, but it took a couple years before they really got going. And so, maybe 1957 is 2016. Maybe there's some similarity there. So we're looking at like a bird's eye view here, a 10,000-foot view of the market, and we're at one of the 3 most oversold points ever on a long-term basis. Again, late 50s, 2000. So, but in the late 50s, it took a couple years to get going. It's taken a couple years to get going. Fundamentals are not in place yet. When the market senses the Fed's going to start cutting rates, that's when fundamentals will be in place and we'll see a new bull market. Gold stocks against the S&P 500. This hit an all-time low. So just a couple months ago, gold stocks relative to the stock market, cheapest ever. And a lot of charts look like this. They look very similar as far as valuations for gold stocks. Yeah, I mean, look what happened. Late 50s. The Barron's Gold Mining Index looks a lot better than this, but late 50s, that move started. Strongly outperformed stocks around 2000. So it's coming. It's coming. The key is just timing, and we have to pinpoint it. Here's another one. So this is just price to sales for metals and mining relative to the overall market. Look at that. All-time low, or 65-year low. Bird's eye view, gold stocks, I mean, they're potentially the cheapest ever. If not the cheapest ever, they're in the 98th percentile for how cheap they are. And so we know that the stock market is very richly valued. Valuations are near all-time highs. This is the CAPE ratio. And so there have been, I mean, look at when valuations in the stock market as far as CAPE have peaked. Great Depression, the mid-60s, 2000. How did gold stocks perform? After these valuation peaks, they performed very well. I mean, this peak here in 66, again, the bull market started before then. We could be seeing a similarity where the 2016 leg started before CAPE peaked, but it looks like CAPE has put in another peak. So this also bodes very well for gold stocks and precious metals. So this is a bear analog chart of silver, looking at mega bear markets, and I stopped. These ended all at the points where silver started to have a strong move higher. So there's 3 other examples here, and the silver, after these 3, rallied about 65%, 92%, and 93% in the next 12 months. So when we start that move up, silver has a chance. I mean, when it starts moving, obviously we don't know. I mean, did it start a couple months ago? Probably not, in my opinion. But when it starts moving, there is a good chance it could double in a year. And what we're seeing is I mean, I like the comparison to the late 50s. I think that's more apt than to the mid 80s. But we're kind of close to a double bottom here in silver. And that's very similar to what happened in 80, 86. But I think the market, I mean, after the silver in 86, I mean, it just shot higher for like a year and that was it. I don't think we're going to repeat that. Okay, so to summarize, we have one more leg down. It's already started. The key during this leg down is to watch how precious metals hold up relative to foreign currencies and especially the stock market, because the stock market is going to influence Fed policy, and especially when we get that shift where the market knows the Fed is done hiking and they're looking to cuts, that's when we want to be buyers. And because of the valuations, we have one of the greatest setups ever for precious metals. And I think we are going to see the start of a bull market before the end of the year. And look, timing isn't everything. It's the only thing. And so what matters, if we time this right, as long as it has gold in the name, you can come to MIF and just, if we know that the Fed is going to start cutting, come to MIF, just buy every company with gold in the name. And you're going to make money. Okay. Thank you.